Morning, everybody. Thank you for joining the call this morning. We're going to get started. I'm Nancy Sears from the region, and we have been fortunate enough to have two colleagues from Grant Thornton join us, and I'd like to do an introduction to both of them. So John DeLisio is the National Real Estate and Construction Leader. He has over 20 years of experience in providing business advisory services to private company owners, managers, and stakeholders with a diverse range of services. Over the years, he has expertise in the real estate industry involving structuring investments in Canada and providing creative planning advice in connection with acquisitions, dispositions, and merger strategies for real estate organizations. He has also consulted on issues affecting business owners, including succession planning, tax extraction, and effective tax rate management strategies. Outside of work, John has tutored in-depth with the CPA in-depth tax courses and co-authored a number of tax publications. He's also a member of the Ontario Institute of Chartered Accountants, the Canadian Tax Foundation, and the Vaughan Chamber of Commerce. During his spare time, he likes to spend time with his family, participating in various sports events, and alternatively, enjoying outings at the golf course. So welcome, John. We're really happy to have you here this morning. And welcome, Vanita. Vanita Leonard is a senior manager in the Grant Thornton's domestic tax group. With over 8 years of a mix of public accounting and industry experience, Vanita brings a well-rounded background to her client engagement. Vanita has spent the majority of her career specializing in tax, and specifically tax matters affecting clients in the owner-managed manufacturing and real estate space. Vanita worked mainly with owner-managed clients to help them in their businesses at every stage, from startup and growth to diversity and real estate planning. Since the beginning of the year, Vanita has been following the progress of Bill 145 and has been focused on educating real estate professionals what this opportunity means to them. She's also a member of the Canadian Tax Foundation and a facilitator for the CPA PEP program. So again, welcome, Vanita. We're really happy to have you. And I'm going to turn myself off and mic myself and let you mute myself and let you guys go ahead with your presentation. So thanks so much.
Thanks, Nancy. Thanks for the kind introduction. So first, I'd like to thank Remax Integra with the opportunity to speak to you today. As mentioned, my name is John DeLisio, and I lead the National Real Estate Group at Grant Thornton. And we're pleased to speak to you today about some of the advantages and disadvantages of setting up a personal real estate corporation, or as I call it, PREC. We will also distinguish between the new PREC legislation and the Remax agent brokerage program, so you can get an understanding of the relevant differences. Vanita Leonard is a senior tax manager and has been instrumental in our practice in following the path of the new legislation. So she will guide you through the benefits of incorporation, and then I will discuss some typical structures that may be set up. We will have time at the end for questions. So if you do have questions, please include them in the Q&A function, which is the bottom right portion of your screen, and we'll try and answer as many as we can. Please appreciate that the legislation is new and there are still some clarification points, so please consult with your individual advisors as appropriate. With reference to the agenda, we will cover 5 main areas. So as discussed, we will discuss the benefits of incorporation, and those benefits would equally apply to PRECs and the Remax agent brokerage program. We will then give an overview of both the Remax program and the new PREC legislation. We will discuss how we as professional advisors can help you, and we'll also go through a summary of the relevant differences between the two programs. So now I'll pass it on to Vanita. Vanita?
Thank you, John. So good morning, everybody. As John mentioned, I'll go over the benefits of incorporation now. So incorporation opens the door to a wide range of tax planning opportunities to you. So essentially, you can probably benefit from some potential creditor proofing, have income tax deferral opportunities, have access to capital gain exemption. So, I'm going to go over these in a little bit more detail in the next few slides. And you can also have some flexibility with CPP. So if you're as a self-employed right now, you're required to remit the employee and employer portion of CPP. But if you do decide to incorporate, you have a choice of how you can get remunerated. So you can decide to do to pay yourself a salary or a dividend. If you decide to continue paying yourself a salary, you will have to still remit CPP. But if you do decide to pay yourself a dividend, you're not required to pay any CPP, so you will have a little bit more cash in your pocket. You will also have some opportunities to do income splitting, have like a retirement and estate planning. So as John mentioned earlier, these benefits that you see listed here can be accessible under both options. So whether you decide to incorporate under the Remax brokerage program, or if you do decide to go and set up your own PREC. Next slide. So typically, corporations provide limited liability, but it is restricted as corporations do not limit your professional liability as a realtor. However, there may be opportunities to set up holding companies to help with the liability issues, subject to some confirmation from legal counsel. Next slide. One of the most important and known benefit of incorporation is the opportunity to benefit from income tax deferral. So income tax incorporation provides you with the ability to pay less taxes now and defer the taxes when your income is lower, such that, for example, when you retire. For instance, if you are in a high tax bracket currently, your marginal personal tax rate is likely to be at least 53.5%. However, if you do earn the income through your corporation, any income up to $500,000 will be subject to the small business rate of 12.2%, and any income above the $500K is going to be subject to a rate of 26.5%. So as you can see, either of those rates are a lot lower than the personal tax rate, which provide for significant tax deferral on an annual basis. Next slide. As you can see on this slide, so as a sole proprietor, which is the situation you're in currently, even if you don't need all your income to fund your personal lifestyle, all your earnings are taxed as earned. But if instead you incorporate, which is on the right side of the structure, and earn your income in your corporation, your earnings, and you don't need the funds, you don't need to withdraw the funds from the corporation, your earnings will be taxed at the lower rate in the corporation, which allow for significant tax deferral. It is, however, important to note that if you do withdraw the funds out of the corporation, either by way of salary or dividend, you would still be subject to the same high personal tax rate as if you earned this income personally. So to the extent that you don't need the cash, you can leave it in the corporation. There's huge tax saving opportunities there. On the next slide, I'm going to run through a numerical example of how this tax deferral works. So let's take, for instance, Justin. He is a realtor in Ontario. He earns an average of $300,000 in annual income after expenses, and he requires $100,000 to fund his living expenses. Justin is also interested in investing in rental properties with any extra cash available. So how can incorporation help Justin achieve his objective? Next slide. So as you can see on this slide, if Justin incorporate and earns the $300K in his corporation, he will have to pay corporate taxes of around $36,000, which approximates the small business rate of 12.2%. And after paying himself a dividend to fund his personal living expenses and pay his personal taxes, he will be left with extra cash of $136,000 to reinvest at the corporate level. If instead now he earns this $300K personally, he'll have to pay personal taxes of around $121,000. He will still have to remit CPP, which is around $5,800, and after spending the $100,000 to pay for his personal expenses, he's left with extra cash of around $72,000 to reinvest at the personal level. So as you can see from this example, incorporation had helped Justin to benefit from a tax deferral, and he's left with extra cash of almost $64,000, which he can now reinvest in rental properties. Next slide. Another benefit of incorporation that you can enjoy is the access to capital gain exemption. You may or may not know, but the capital gain exemption is indexed every year for inflation. So for 2020, the capital gain exemption is $880,384. So if down the road you're looking to retire or exit out of your real estate practice, planning can be done to ensure that your shares qualify for the capital gain exemption such that the first $883,000 of your proceed would be tax exempt. So down the road, this can be a huge tax saving or planning opportunity for you if you do want to exit out of your real estate practice. Next slide. So as you may have heard, incorporation also brings to the table some income splitting opportunities. This is one of the main advantage up until 2018, when finance introduced the new rules known as TOSI. So it's short for tax on split income. The rules are quite complex, so I'm not going to go through their technicality, but essentially now there are some limitation on who you can income split with. In summary, now you can income split, that is, pay a dividend to your spouse or an adult child if they are actively involved in the business. And by actively involved, I mean that they usually have to show that they spend an average of at least 20 hours weekly working in the business in order for you to be able to income split for a dividend by paying them a dividend. That being said, each person's situation would be different, and therefore there are ways to structure it. So I would advise that you discuss it with your tax advisor to see how you can structure your corporation if this is one of your objectives for incorporating. Next slide. So now I'm going to go over a little bit of overview of how the incorporation process works under the current Remax Integra brokerage program. So some of the criteria that you need to have in order to qualify here is that the eligible agent needs to incorporate as a licensed broker and register their brokerage with RICO. Once incorporated, the incorporated agent will enter into a franchise agreement with Remax and a broker service agreement with the existing brokerage. This broker agreement will allow the agent to use the brokerage trade name and services in order to carry out the business of trading in real estate, as well as earn the commission income in the corporation. Next slide. So to provide a little bit of visual, here's an overview of how the brokerage structure looks like. So as I said, you have the Remax Integra, which is the main broker on top, and the incorporated agent will now have enter into a franchise agreement with them. They will also have a broker service agreement with their existing brokerage so that they can carry out the trade in real estate under the trade name of the brokerage and also have access to all the services that the brokerage provide. I do want to note here that as you can see under the structure, you're not restricted in any way you want to set up the shareholdings of your corporation. So for example, you can have a family trust, you can have holding company, you can have other team members as shareholders of the corporation. There's no restriction. There's also no restriction on what type of shares they can own. So anyone in the corporation can have voting or non-voting shares in the corporation. Next slide. There are some eligibility consideration that you need to take into account. So typically the programs, one of the condition or I guess consideration is that the agent must be making at least $500K or more annually, and this is an amount that they estimated based on evaluation of how much it would be to make it beneficial for them to incorporate under this program. The agent is also need to be prepared to incorporate and register as a brokerage with RICO and to enter into a franchise agreement with the main broker and a broker service agreement with the existing brokerage. They will also have to perform a name search with RICO to register with RICO. Next slide. So there's also a few documents as listed here that needs to be put in place to govern the relationship between the three parties. So these documents, the purpose of these documents is basically to summarize the different relationship and roles between the different parties to ensure also that all the information is kept confidential. And these are, you can get more detail. I won't go into all the specifics of these documents, but if you do decide to incorporate into this program, the Remax Integra can give you more detail on each of these documents. Next slide. So with this, in order to set up your brokerage under the Remax Integra program, there are some fees that you do need to consider. One of them is the agent incorporation fee, and then there's also a renewal fee every 5 years. So this fee is basically to get the registration set up, have all the documents that I have discussed on the previous slide in order to facilitate the incorporation. There's also an additional unique location fee if you do decide to be located in another office other than the main brokerage. You will also have to separately pay a flat fee to RICO to register your brokerage, and there is also a fee for each sales associate that you register. Additional fees need to be paid to the real estate board. And here on the slide, we have the fees for the Toronto Real Estate Board, but fees might be differ for different boards as well. So just one thing to consider. Next slide. On top of the program fees, there are also some external professional fees that you need to consider. So if you do decide to incorporate, you will have to hire a lawyer to file an article of incorporation. You would also have to consult with your accountant to decide how you want to structure your corporation. That is, who you want to have as shareholders, what type of shares you want to issue. So these are things that you need to consider before incorporating. If you do have currently significant asset that you're using in your business and you would like to transfer over to your corporation, you would likely have to hire the services of evaluator to assess what are the value of these assets to properly transfer these assets into the corporation at the appropriate value. There's also the annual compliance costs that comes with incorporating. So every year you will have to prepare a financial statement as well as file an annual tax return. So you'll have to consider that as well in the cost of incorporating. I do want to point out here that these costs listed here, that is the external professional advisor fees, would be similar that if you do decide to instead incorporate a PREC rather than incorporate under the Remax program. Next slide. So shifting gear a little bit here, I want to now move on to discuss the new PREC legislation. So as you are all aware, personal real estate corporation is now a reality in Ontario. In other words, you as a real estate professional are now able to incorporate and earn your income through your own personal corporation. Although the legislation was approved and enacted on October 1st, 2020, there are still a lot of gray areas in the legislation that we are hoping that RE and RICO will release additional guidance on. Next slide. I'm now going to go through some of the attributes that your corporation should have in order to qualify as a PREC. The first and most important criteria is that the controlling individual, who is the registered broker or salesperson, is the only one who is allowed to own voting shares of the corporation. They are also the only person who can be the director and officer of the corporation. In other words, the legislation doesn't allow anyone else beside the registered broker or salesperson to control the PREC. Family members can own shares in the corporation, but they can only be non-voting shares. Family members are defined in the legislation as being the spouse, children, or parent of the registered broker or salesperson. Non-voting shares can also be owned by one or two individuals as trustees for minor children of the registered broker or salesperson. Another important criteria is that the PREC itself is not required to register with RICO if it does meet certain conditions, and I will cover these conditions in more details on the next slide. Finally, the registered broker is required to notify RICO of the legal name and address that they have chosen for the PREC, and a written confirmation should be received from RICO that the PREC has met all the conditions to be eligible to be exempted from registration before any remuneration is paid from the brokerage to the PREC. Next slide. So as I mentioned on the earlier slide, there are some conditions that needs to be met for the PREC to be exempted from registration. So what are these conditions? The first condition is that the registered broker must be employed by the brokerage. Employed here means that the brokerage is the one that has to appoint the broker, authorize a broker to carry on the business of trading in real estate. the definition of employed includes an independent contractor relationship. Secondly, the PREC itself does not carry on the business of trading real estate, other than providing the services of the realtor to the brokerage. So what does this mean? It means that you as a realtor can trade in real estate, not your PREC. That is, your PREC cannot advertise a trade in real estate, or it cannot receive any compensation from a trade in real estate. The PREC also cannot act as a brokerage, and it cannot receive remuneration from trading in real estate other than from the brokerage. It cannot also hold any trust account to hold deposit from client or customers. Lastly, there should be a written agreement between the PREC, the controlling individual, and the brokerage that will summarize the relationship between the three parties as well as the compensation structure. If the PREC meets all of these conditions, they will then be exempt from registration. Next slide. As discussed on the previous slide, one of the requirements of the PREC is that the controlling individual must be employed by the brokerage. One of the potential risks that we see with this requirement is that Canada Revenue Agency, that is CRA, might argue that the PREC is carrying on a personal service business, PSB, where the individual is an employee. Independent contractors are exempt from the PSB rules. Under the Income Tax Act, there are rules that penalize a situation where an individual would incorporate a corporation to receive what otherwise would personally be perceived to be employment income. So what are PSBs? So a PSB exists when an individual, in this case would be the registered broker or salesperson, perform services for an entity that is here would be the brokerage for the corporation that is a PREC, and it is reasonable to conclude that this individual is working in the capacity of an employee for the brokerage. So why are PSBs bad? If the PREC is deemed to be a PSB, there are some consequences that can arise. For example, the realtor will not be able to claim the small business deduction, as any income earned in the corporation will not be considered to be an active business income. As a result, the PREC will be subject to a corporate tax rate of 44.5% instead of the small business rate of 12.2%, which essentially eliminates the benefit of income tax deferral and all the benefits that comes with incorporation. There's also some limitation on what type of deduction that the individual can take from the PREC now that it's considered to be an employee. So that's all these negative consequences mean that it is important for you to work with your legal and tax advisor to ensure that you qualify as an independent contractor and not as an employee of the brokerage, in order to make sure that the PREC is not perceived to be a PSB. So on this note, I'm going to pass it on to John, who will go over some different ways that you can structure your PREC to not fall into any traps. John?
Thanks, Vanita. So if we could just go to the next slide. So as Vanita indicated, we're going to go over some typical structures that you may be considering when you're setting up your PREC. We'll go through some tips and traps, and then we'll conclude with a summary of the differences of the new PREC legislation and the Remax brokerage program, so you can have a summary that you can refer to. So in this particular structure, it's fairly straightforward. The PREC is set up. We have the controlling individual, Justin in this case, who's the registered broker or a realtor. He owns all the equity or voting shares of the PREC. If he so chooses, he can include family members in the shareholdings of the PREC. The family members would own non-equity or non-voting shares. And there would also be an agreement that would need to be signed between the PREC, the brokerage, and the controlling individual to govern the relationship between the parties. In this particular example, to the extent that potentially the family members are actively engaged in the business of the PREC, and typically looking at 20 hours or more in the week in terms of their contributions, then potentially dividends can be paid from the PREC to the family members in order to split income. So can we go to the next slide, please? So we continue with the example given, fairly straightforward. Again, Justin owns the equity or voting shares of the PREC. He's the registered agent, earns the commissions that are directed into the PREC, and he's chosen to set up family members as shareholders as well that own the non-voting and the non-equity shares. In this particular example, the PREC is not only earning commission income, but because it's paying a lower rate of tax, it has decided to earn passive income. So for instance, potentially a purchase of a rental property that it will earn rental income from, and decided to include that rental purchase in the PREC. So some of the traps here are that when passive income is earned by a corporation, and that passive income is anywhere between $50,000 and $150,000. The small business deduction, so that's the income eligible for the 12.2% rate. The small business deduction gets ground down subject to the amount of passive income. So passive income in this case is the rental income from the purchase of the rental property. It could also be, if the PREC decides to purchase an investment portfolio and earns interest or capital gains from the investment portfolio, that would be classified as passive income as well. So to the extent that the passive income exceeds $150,000, in this case, the small business deduction would be ground down entirely, so that all income that the PREC earns from commissions wouldn't be subject to a 12.2% rate, but would instead be subject to a 26.5% rate, because there's a commingling of assets. There's the commission income being earned in the PREC, and there's also passive income being earned as well, in terms of whether it be rental income or interest or other passive income from investment portfolios. So if we go to the next slide. So what this slide does is it incorporates a holding company concept in order to determine the investment possibilities that could pertain. So the family members in this scenario set up a holding company. The holding company owns the non-equity shares of the PREC, and Justin continues to own the equity shares in the PREC itself. Dividends could be paid from the PREC to the holding company. Those dividends would not be subject to tax, depending on the ownership structure. And then the holding company could buy the rental property that was otherwise owned by the PREC in the previous example. And so the benefit of this structure potentially could be that, again, depending on the ownership, the PREC would not, the small business deduction in the PREC would not be ground down. So it would still be able to earn commission income up to $500,000, pay 12.2% tax. And then the holding company that bought the rental property, it would do that in the holdco, and the small business deduction again wouldn't be affected, depending again on the ownership. What this also does is it purifies the PREC. So what does that mean? Any excess cash out of the PREC is paid up to the holding company. The PREC, to the extent that Justin potentially is a member of a team. Let's say he's a member of a team of 5 individuals. Each of those individuals have set up their own individual PREC, and Justin is thinking about selling the PREC to one of his team members. In that case, in order to qualify for the $883,000 capital gain exemption, the PREC would not have passive income or a rental property or an investment portfolio. That's done outside of the PREC, and it wouldn't grind the capital gain exemption or affect the eligibility of the capital gain exemption to the extent applicable. So we go to the next slide, please. So here we've introduced a holding company potentially in Justin's case. Again, dividends can be paid up to the holding company, whether it be Justin's holding company or the family holding company. Again, Justin owns all of the equity shares or voting shares, both within the holding company and the PREC. The holding company that the family members own the non-equity shares. So dividends can be potentially paid up tax-free from the PREC to the holding companies. they can be invested. And again, depending on the ownership structure, there may be an element of creditor protection that you may be able to enjoy where you set up holding companies as well. So next slide. So with reference to some of the flexibility that is offered with the PREC, as we learned earlier, there's only one registered realtor or broker that can earn commissions within the PREC itself, but any excess cash that the PREC owns or has after paying the low rate of tax, to the extent that that has not been taken out of the PREC as a dividend or wages, the PREC itself can invest in passive assets, for instance, an investment portfolio. It can invest in other active businesses, or it can own real estate. But as we kind of went through earlier in some of the examples, you may want to think about whether a holding company structure helps as well. So next slide. So how can we help? So once you've decided that you want to set up a PREC, you're going to have to make a decision as to whether family members should be included based on their income levels and your own income level, what share classes you should own. Well, we know that the controlling individual can only own equity shares, or potentially non-equity as well, but family members can only own non-equity shares. So, in terms of structuring, what's the best structure? Also, when you're transferring your business personally into your PREC, you want to make sure that you do that on a tax-deferred basis. So there's typically a Section 85 agreement that transfers things that you own, for instance, that are used in your realtor business. So, for instance, equipment, furnitures, and fixtures, receivables, if that's applicable. Want to make sure that's transferred on a tax-deferred basis. The HST filings are done to make sure that HST is not applicable. To the extent that any of your assets require evaluation, we can assist with valuing the assets. And typically when lawyers incorporate a company, other than just giving a company with plain vanilla common shares, they typically look to the professional advisors to provide them with instruction on how to set up the corporation, again, what shares to issue, the timing of moving the assets in, putting in the holding company, that type of thing. So we can help with that as well. So next slide. So now that your PREC is established, it is a separate entity, so it'll have to prepare financial statements and file annual tax returns. To the extent that wages or dividends are paid, the relevant T4 and T5 slips need to be prepared. As we all know, with reference to keeping track of all your expenses and making sure that the bookkeeping is up to date, we do offer a cloud-based program, which is a online program that's secure and provides up-to-date information that you can use. So we have a practice that does help with bookkeeping and cloud accounting type services. Next slide. So in terms of tax planning, does it make sense to pay family members wages? Are they able to split income by paying dividends? How should the structuring be done in terms of your excess cash that you now you enjoy in your professional corporation? The rate of tax, if you do incorporate an entity, will hopefully be subject to a lower tax rate, so you'll have excess cash to invest. How do we plan to make sure that you meet the eligibility requirements from a capital gain exemption perspective? Are you buying or selling a real estate practice, and what are the implications with that? And also from an estate and will planning perspective. So next slide. So now we're going to go through some of the differences between the Remax brokerage structure and the PREC structure. So what we've done is we tried to isolate what the major differences were in the two programs. So for instance, if we're starting with registration, as you all know, under the Remax brokerage program, registration is required with RICO. So you are acting as basically a mini brokerage versus the PREC, where as long as the conditions are met, that registration would not otherwise be required with the PREC structure. The shareholders, there's no restrictions on the shareholders under the Remax brokerage structure. So you, as Benita outlined, you could have family members, a trust with whoever the beneficiaries you prefer to have. they can own equity shares or non-equity shares. So there's no restrictions on the types of share ownership that is under the Remax brokerage structure, versus under the PREC structure, it's only the controlling shareholder or the realtor or broker that can own the voting shares, and family members can only own the non-voting shares, but there can be a trust only for minor beneficiaries that can be set up. As far as remuneration, commissions paid into a Remax brokerage structure, you can have a number of real estate agents earn commissions into one entity. So you could those that operate as teams may have two or more shareholders in the entity, and that entity can earn commissions from any one of those registered brokers or sales persons. Under the PREC structure, it limits the commission income to each individual realtor. So if you do operate in teams, that each individual team member would have to set up their own PREC and presumably have an agreement to govern how commissions are earned. With reference to activities, typically, the restrictions on activities, other than those outlined historically in the legislation, the restrictions are lack thereof, versus in a PREC, the corporation cannot trade in real estate other than providing the individual services of the controlling individual to the brokerage. From an operational standpoint, under the Remax brokerage structure, the entity operates basically as a brokerage, versus the PREC, where there's actually a restriction from operating as a brokerage. Next slide. So in terms of setup fees, there are some additional fees that need to be paid to Remax, Integra, to RICO, to the relevant real estate board, in order to set all of the documents in place. So those fees were outlined. Benita outlined the nature of those fees. So all those fees can be eliminated under the PREC structure because they would not otherwise be applicable. In terms of external professional fees, so these are fees that you would have to get regardless of which structure you set up. These are, the legal fees to do the actual incorporation of the entity and the related accounting, tax, and valuation advice. Those would be the same under both structures, under the brokerage structure and under the PREC structure. And then just from an administrative standpoint, it looks like there's 5 agreements that potentially need to be enacted under the brokerage structure, versus under the PREC structure. There's one governing agreement that covers the responsibilities of each of the parties with reference to the brokerage, the PREC, and the controlling individual. So that ends our presentation. We now have some time for questions. So Nancy, if you don't mind, if there are any questions, we'd be happy to answer them or try to answer them.
That's great. Thank you so much, John and Vanita. We have a few questions here, so I'm going to get them out to you. So the first question we have is from Andrew. He actually has 2 questions. Firstly, if planning to retire in 5 to 7 years, is it still worth doing a PREC? Secondly, if you own rental properties, can they be in the corporation, and what are the advantages? Are there any advantages?
So with reference to the first question, if he's planning to retire in the next 5 to 7 years, I would say if you're in the income threshold that you're earning income, above let's say the $220,000 mark, and why I picked that number is because that's the threshold before you start paying 53% tax in Ontario. If you're in the upper echelon, it may make sense to incorporate a PREC, take the advantage of the lower tax rate, and then when you retire, the excess cash in the PREC, because you're in a lower bracket, that can be paid out to you and be subject to your marginal rates where you don't have any other income. With reference to the rental property, so yes, rental properties can be purchased by a PREC. We went through some examples where it makes sense to buy it in the PREC, or whether it makes sense to move cash into a holding company to purchase the PREC so that, we were careful of the small business deduction and making sure we have full value for that we are paying 12.2% tax on the commission income that's being earned. Very generally, the tax rate on passive income in a corporation is about 50%. If you earn that passive income personally and you're the highest rate, the tax rate is about 53%. So there's a little bit of a deferral there, depending on whether you're in a personally or in a corporation.
Thank you, John. Appreciate the answer. We have another question from Derek Vilmar. Legislation says the registrant can pay himself more than what the PREC collects from the brokerage. Is this on a year-by-year basis or on a cumulative basis? For example, if the PREC earns $100,000 in each of the 2 consecutive years, can the PREC pay the registrant $75,000 in year 1 and $125,000 in year 2?
So that's a good question. I mean, typically there are no restrictions so you don't have to pay yourself out in the PREC in the current year. So if you earn $100,000, that money can be invested in the company and it doesn't need to be paid out. So there is some possibility to defer the personal element. With reference to your question in terms of it can't be paid more, I'm assuming that that's the case, that can be done, but I have to go back and just reconfirm that specific example.
Okay, thanks, John. The next question is from Ken Cameron. Almost all the last 5 slides are for sub-brokerages, not PRECs. I believe that to be true. The last few slides had to do with our agent incorporation program. Sorry, I don't have the slides in front of me. Ken, I can talk to you about that after. Andrew had another question. What if the rental properties are already owned? He asked the question before. So what if he owns the rental properties already?
So owned personally or? Okay.
I'm assuming he means personally, yes.
Yeah. So yes. So if you do already earn the rental properties personally, there's 2 things that you may want to consider before you transfer them to a PREC or another entity. One is that owning rental properties personally, of course, if there's any liability issues associated with slip and fall or anything like that, that would go into your, you would be subject to the legal issues personally. So there may be an advantage to moving that rental property, whether into a corporation or some other vehicle that will give you a legal protection. So that's number one. That can be all done on a tax deferred basis. The only other caveat I would throw out there is that, if you are moving or transferring property from a individual to a corporation, you might want to think about the land transfer tax implications, because there may be land transfer tax. There likely is land transfer tax on that transfer because the beneficial ownership is changing from you as an individual to a corporate entity. Now, I hinted at there's some other avenues. So, having a partnership that may own a rental property is another alternative that may provide the legal protection and may avoid some of the land transfer tax issues. So there are ways to transfer properties depending on your objectives, but be wary of some of the traps that I just mentioned.
Thank you, John. So we have one last question, and it's from Ed Doucette, who Ed is currently under our agent incorporation program. And his question is, I am currently operating as a Remax sub-franchise. I am an individual agent, no other agents to pay. I have a separate corp holding my property that I pass funds to and will continue. Can you tell me if any reason why I wouldn't cancel the brokerage and move to a PREC? So he's asking for you to give some advice as to what would be best for him, to cancel the sub program or to stay with or open a PREC.
Yeah, so I'd be happy to talk to you on your individual circumstance. I would say generally, if you look at the differences, you want to evaluate some of the advantages that one gives over the other. So in your current situation, you said you're the sole shareholder. So if you're considering to do a freeze or something like that, there may be the more discretion or more availability to introduce other shareholders, including trusts. That being said, if you if you have family members and you want to multiply the small business deduction, you may want to think about how to set that up from a PREC perspective. So having the PREC have a small business deduction, and perhaps using another family member to own a corporation that is buying and selling real estate as well. So you may want to think about that. So I think it's it depends on your individual circumstance and your objectives as you go forward, because there are pros and cons to each program. And of course, I'm sure as everybody is thinking, what are the relevant fees that you would need to continue to pay under the brokerage program versus if you participate under the PREC program.
Yeah, I would agree with you, John. Ed, I think the best thing to do is to really talk to your accountant and get some advice onto how you want to look towards the future, because there is differences, as we clearly stated in our comparisons. So I think it'd be something that you would definitely need to look at to see what makes most sense for you to do. So I don't think we have any more questions. Let me just make sure I got them all here. I'm having a problem with my, there's one more, sorry. What happens from Sebastian, and the question is, what happens to the monies that accumulates in the PREC? If the salesperson / broker dies, what is the tax effect?
So upon death, there's a deemed disposition of all the assets that you own. So in this particular case, you would own shares of a company that owns cash. So if it owns nothing else but cash, the value of that company would be equal likely to the cash value. So there would be a deemed disposition of the shares personally that you'd have to pay up to, call it 26% tax on. But I would say there may be opportunities to help with the estate planning, because there's a whole bunch of different things you can do when you die to help to mitigate some of the taxation. So again, if you have more questions like that, we'd be happy to talk to you about your individual circumstance.
Thank you. I think that is all the questions that we have. On the screen, there is John and Vanita's personal information, their emails and their telephone numbers. If you have questions, I understand it was a lot of information today, and everyone was taking it in and relating it to their own personal circumstances. And we may not have been able to answer all of your questions, or you didn't have questions that you wanted to pose. So please feel free to reach out to John and Vanita, and they'll be happy to answer any of your questions regarding your own personal circumstances. And we'd like to thank John and Vanita for their time today. And we really appreciate you coming on and helping out with explaining the programs and the differences between the two. And again, thanks for joining us. And thank you, everybody. If you have any questions, please let us know. Thanks.
Thanks, Nancy. Thanks for all your help.
Bye, everybody.
Thank you.
Thank you.
Bye.
Bye.
Bye.